Everyone's noticed that lately, filling up your car doesn't have to mean emptying your wallet. That's thanks to the tumbling price of oil, down from almost $100 a barrel back in 2013 to around $30 or less right now. But what's behind the collapse?
It's really just a combination of supply and demand factors. On the demand side from China, we just see much lower demand for oil than was expected. At the same time, the US and Europe are getting more efficient, and that's basically run head into increasing supply in the Middle East. We're now looking at Iran being fully open with all the sanctions being lifted, and it's just the perfect storm for oil prices.
One factor that's had a big impact on oil prices here on Wall Street and indeed around the world came into play late last year. That's when the US Congress voted to end a ban on American oil exports that had been in place since 1975. That meant that US crude producers could sell onto the already saturated international market.
And it's this technology that's helping them do so.
We see increasing production from fracking in the United States. So it's possible to me you see a rebound in oil prices, but 10 to 15 years out, I just see structural factors that are going to be pushing the demand for oil down.
And prices will continue falling as long as there's an oil glut. But the nation with the world's largest oil reserves, Saudi Arabia, has been refusing to cut production, putting some African and Latin American producers in an economic vice.
Saudi Arabia produces about a third of the total OPEC production, and they are the ones that hold flexibility in their ability to produce. And they are really the only country that's been willing to voluntarily cut back on production in the past. So the key decision maker is Saudi Arabia. Only if they make a decision would any change happen.
That decision doesn't seem forthcoming for now, meaning OPEC members are bitterly divided at a time of unprecedented challenges and change. Lorna, Shaddick, CCTV, New York.